Hello and welcome to the Business Standards Morning Show. I'm Kanishka Gupta, and here is a look at the stories for the day. The acting CEO and accountable manager of Jet Airways quit this week, dealing another blow to the company, which has seen at least two resignations at the top level in the last few days. Now, the date to seek all regulatory permissions for restarting the defunct airline has also been extended twice. So, why the relaunch of Jet Airways is looking so turbulent? Our next report finds out more.
Waiting in the wings since April 2019, when it was grounded due to a financial crisis, Jet Airways has been looking to hit the skies for long now. The new owners, British firm Calrock Capital and UAE-based entrepreneur Murari Lal Jalan, have time and again asserted that Jet Airways 2.0 will take off in the beginning of this year. But will everything go as planned? The company has recently seen a slew of resignations. This week, Sudhir Gaur, its accountable manager and acting chief executive officer, deboarded the airlines. Gaur was heading the operations team and was involved in key negotiations for airport slots. Both the airline's finance head and head of management information systems had quit 2 weeks ago. We reached out to Jet Airways for their stance on these recent developments, but didn't receive a response by the time of publishing this video. While Gaur's replacement has been found in Head of Training and Standards in Nepal Airlines, PP Singh, there are several other tasks to complete before Jet Airways 2.0 can take off. The Calrock Jalan consortium is yet to finalize its fleet plans. Jet Airways 2.0 is understood to have a fleet of 11 aircrafts, including Boeing 777, 737, and Airbus A330 on its books now. The two company owners had said that the airline would commence domestic operations with 6 narrow-body aircrafts in 2022, and also that the airline plans to have a fleet of 100 plus aircrafts. Meanwhile, Rakesh Jhunjhunwala-backed Akasa Air has already ordered 72 Boeing 737 MAX aircrafts. The consortium had even approached the National Company Law Tribunal, or NCLT, asking it to declare December 22, 2021 as the effective date for the implementation of the revival plan. However, the NCLT refused the plea and asked the consortium to expedite its efforts to revive the airline. A banker privy to the matter told Business Standard on condition of anonymity that lenders have become jittery as the Jalan Calrock consortium hasn't brought in any funds or completed any process to restart the airline. But another person involved in the revival plan claimed that all stakeholders were working towards the revival and denied that there was any disagreement between the consortium and the lenders. To get a better understanding of the challenges facing Jet Airways, we spoke to Mark D. Martin, CEO of Martin Consulting, an aviation consulting and safety firm based in Asia.
One of the major challenges that any airline faces, especially when you start operations in India, is linked with getting the airline up and running, keeping in view DGCA regulations as well as operation requirements. Now, the Jet Airways 2.0 that we know at the moment is just a brand and a piece of paper that's been acquired by the Calrock Jalan consortium. To create the operating system, the operating environment, and the operating structure takes some amount of time, and to bring that up to speed is going to be a challenge. Furthermore, I think one of the reasons why that there would be a short delay of sorts would be on account of the new operating system and the new operating manuals being approved by the DGCA. It's extremely less likely that they would start operations in 2022, at least by Q2, because we are dealing with several factors at the moment, including the resurgence of the COVID pandemic. So this should lead to some amount of delays, but I think the deadlines that Jet Airways 2.0 has set up as part of its restart is a bit aggressive, and I'd probably be short of saying a bit too naive in understanding some of the ground realities such as they are. I think realities of starting an airline need to be factored in, and along with that, a more mature, well planned, and structured timeline should be defined.
Apart from an aggressive deadline, there's another area of concern.
The experience, because the experience of Jet Airways was actually on account of its previous promoters and the previous management that created that experience, which we all know and which is so unique and synonymous with Jet Airways. The service, the way they make you, the whole experience outline. I think that is something which would be a challenge for the new consortium to create. And reason being for that is because a lot of the key people in management that created that experience or helped create that experience are no longer with the airline. Some have passed away, and obviously Jet Airways, as we know, from the experience you had in flight to the customer service, was all designed by Naresh Goyal himself, and there is no Naresh this time. So I think that the greater challenge for Jalan Khal Rock Consortium would be to try and recreate what Jet Airways was. Try and recreate that uniqueness in service quality and service experience that Jet Airways stood out for.
As the expert pointed out, given the challenges it is facing now, it seems unlikely that the refurbished Jet Airways will be able to start operations by the second quarter of 2022. A more mature and structured timeline needs to be defined for the airline's takeoff. Even so, with the spate of senior level exits dogging the company, recreating Jet's uniqueness and service quality will be a major challenge.
After Jet Airways, let's see why a startup scandal has stirred turbulence among global investors. Billionaire Elizabeth Holmes, founder and CEO of healthcare company Theranos, has been found guilty of defrauding investors. Impressed by her persuasive skills, some had even compared 31-year-old Holmes with Steve Jobs. Her rise was dazzling and meteoric, and so was her fall. And wait, she has an Indian connection too. Her reported former boyfriend and the company's COO, Ramesh Balwani, also faces trial in the case. So what lesson does Holmes saga hold for startup investors back home? Our next report finds out.
This week, Theranos founder Elizabeth Holmes was charged with defrauding investors. Holmes now faces at least 20 years in prison. The way she established and sold her startup story offers valuable lessons to investors across the globe now, even to Rupert Murdoch, one of the investors who believed in her idea. Startups can command hefty valuations very quickly, as venture capital and private equity firms in the US's Silicon Valley place a premium on ideas that promise disruptive innovation. New age tech companies can raise millions of dollars in funds even before coming up with a product market fit, or in some cases even a workable prototype. However, in this glitzy world of innovations and disruptions that are waiting to happen, some founders, like Holmes, are spinning a web of lies and charting their path to success by leveraging the greed of investors. They exemplify the fake it till you make it philosophy. Theranos was founded by Holmes, a Stanford chemical engineering dropout, when she was 19 years old. It was once valued at over $9 billion. And how did she pull it off? Holmes claimed to have developed tests that could help in early detection of ailments ranging from high cholesterol and high blood sugar to liver dysfunction and cancer from just a couple of drops of blood drawn from a finger prick at any pharmacy. The small amount of blood was collected in a nanotainer tube and analyzed in a Theranos lab on a proprietary analysis machine called Edison. The invention was believed to have the potential to revolutionize healthcare and slash diagnostic costs. That was until it came to light that Theranos' Edison machines weren't providing accurate results. The company knew this. So it was diluting blood samples and subjecting them to traditional tests instead of using its famed Edison machines. Soon, issues arose with the US Food and Drug Administration. And as more information emerged about Holmes' deceitful pitch to investors, many of them terminated their partnership with the company. In 2014, Holmes was at the top of Forbes' list of America's richest self-made women, with a net worth of $4.5 billion, with her company valued at $9 billion. 2 years later, Forbes lowered its estimate of Holmes' net worth to nothing. In 2018, the US markets watchdog, Securities and Exchange Commission, charged Theranos, Holmes, and the company's former president, Ramesh Sunny Balwani, with raising more than $700 million from investors through an elaborate, years-long fraud in which they exaggerated or made false statements about the company's technology, business, and financial performance. At its core, the Theranos tale is about a bevy of high-profile investors from media mogul Murdoch to venture capitalist Tim Draper not carrying out the adequate due diligence but being seduced by what they must have believed to be a disruptive innovation. Coming closer to home, the Indian startup ecosystem, now the third largest in the world after the US and China, is also maturing at a rapid pace. Some of these upstarts even have a base in Silicon Valley. Last year, 42 Indian startups entered the Unicorn Club. Thrasio Style, Mensa brands achieved the unicorn status in just 6 months of starting up. Indian startups raised over $42 billion across 1,583 funding deals. This was more than 3 times the total funding of $13 billion raised in 2020. In fact, the total startup amount for 2021 was more than the total funding of $37 billion for the last 3 years combined. But in this rush of capital, are our venture capital and private equity investors carrying out their due diligence into the health of these new age companies? There's reason to be a little suspicious on this front. Consider cybersecurity. Over the last 2 years, several Indian companies from Big Basket, Dunzo, Haldirams, Domino's, Airtel and JustPay, among others, faced cyber attacks, which compromised the data of their users. Cybersecurity experts have claimed that in their pursuit for rapid growth, startups often ignore the importance of building a robust cybersecurity posture. So, shouldn't investors include checking the cyber health of a company in their due diligence? Let's take another example. Indian edtech startups raised over $4 billion in the last 2 years, compared to $500 million in 2019. The bigger players are acquiring smaller startups to build edtech super apps of sorts. However, a recent government advisory cautioned the public against trusting the success stories advertised by these online educational companies. While startups obviously need to be ethical in their practices and avoid the temptations of the fake it till you make it model, investors, for their part, also need to do their due diligence. To get a better understanding of how private equity and venture capital firms can ensure that their money is safe and learn the right lessons from the Theranos episode, we spoke to Parth Gandhi, founder and chief investment officer at Bombay Capital.
I'll break this down into a few parts. I'll break it down into first pre-investment and post-investment, because it's 2 phases of when you can actually look at things and get involved in different formats. Pre-investment, the diligence needs to be extensive. One typically private equity funds will hire advisors to help them look at and evaluate financials, legal, accounting. But I think there's another key element that private equity funds will spend time on, which is doing diligence themselves. The team will typically spend and should spend a significant amount of time looking at A, the model, B, looking at, in a startup's case, spending time looking at what the business model is. In the case of Theranos, sure, people did spend time looking at the tests, but possibly spend some more time looking at what is working, what is not. Sometimes with startups, you do tend to have situations where funds have to essentially look at and project what the future will be. And of course, in that case, you look at the models, do the investment, then of course, post-investment, we will spend time as a board member being active. One wants to look and visit facilities. I'm sure that is a key element of what a lot of funds do, and of course, funds should be doing. You go out and visit the different facilities, look at the model of the company, see what works, what does not work. And look, it's about being an active board. That, I think, are the 2 or 3 key factors I would look at.
Clearly, it is not easy to spot the unsafe firm or the one involved in fraud. But as Mad Eye Moody's favorite saying goes, constant vigilance is the axiom investors should follow.
The rise and fall of Elizabeth Holmes may hold several lessons for Indian investors too. Meanwhile, back home, fund rotation has begun on Dalal Street as India gears up for Q3 earnings season. With over 40 companies set to announce their report cards next week, we caught up with Devanshu Datta, an independent market analyst, and Sandeep Sabharwal, founder of AskSandeepSabharwal.com, to understand how the results season may pan out this time.
Global equities witnessed their first bout of selling in the calendar year 2022 yesterday after minutes of the US Federal Reserve's last policy meeting pointed at earlier and faster rate hikes, uncovering a more hawkish Fed than some may have expected. That apart, over 90,000 fresh cases of COVID-19 back home also soured the sentiment on Dalal Street. The frontline S&P BSE Sensex declined over 900 points intraday but eventually settled 621 points lower at 59,602. The NSE Nifty, on the other hand, ended at 17,746, down 179 points. Markets had been on an upswing during the past 4 sessions after consolidating during the last few months of calendar year 2021. However, analysts expect volatility to return to the street next week as India Inc. kicks off Q3 earnings season. As many as 45 companies set to report their December quarter results in the coming week, including Infosys, Wipro, TCS, Mindtree, HCL Tech, and HDFC Bank. According to Devanshu Datta, an independent market expert, the October to December period will be a transitionary phase for the global economy, including India, as inflation is at multi-year high, commodity prices are up, the US economy is apparently growing at a rapid pace, base effect is ebbing in India, and China is cutting down on high carbon industries.
Given all these factors, you would expect the dollar to move slightly higher, and higher US activity should be good for the IT industry, for example. In areas like energy, it is likely that crude oil will go into surplus in Q4, that's January, February. And as a result, you should see refining margins going up. This is good for India in general. The metal space is interesting because you had a sharp correction through November, December, as demand fell in China due to its cutting back on high carbon emission industries. However, production of metals also dropped in China, and now you're getting a lot of people saying that you could have a surplus of demand over supply, which means that metal prices may remain fairly high. I'm not sure how this will reflect in Q3, but if it's true, it should be pretty good for the Indian metal sector, the iron and steel guys, as well as the non-ferrous aluminium, copper, zinc producers going forward. Those are a couple of areas I'd look at. The other thing I would like to be take a hard look at is expansion in bank credit. If you have genuine economic activity, genuine growth in economic activity, that should show up in higher bank credit demand.
For Sandeep Sabharwal, founder of AskSandeepSabharwal.com, high input costs may lead to a miss on earnings expectations.
I think expectations of earnings are pretty high at this point of time, but there also has been significant inflation in terms of input cost pressures. So key will be to monitor how companies are able to manage those. So I would think that currently earning expectations are for around a 25-30% kind of growth, which will be tough to achieve.
Sectorally, Sabharwal expects capital goods, IT and telecom to perform well during the quarter.
I think many of the capital good and infrastructure companies could do well because there the expectations are low. Technology company results are expected to be good because some of the overseas listed technology companies who are operating in a similar space have given good results. But that's something which is already factored in by the markets more or less. Consumer companies we have to watch because their input cost pressures have been high, so how those companies have been able to cope up because earning expectations are very high there. Telecom earnings should be good, so I think that's where they could see some positive surprises. Automobile expectations are very low, so it's possible that we could see some positive surprises by some companies out there.
That said, while these factors are already priced in, there are certain headwinds that may negatively surprise the markets and lead to earnings downgrade post Q3 earnings.
In general, people expected festival demand to be good, but a lot of companies are indicating that because of higher prices, the demand suddenly moderated in the last 2 months of 2021. So I think those are the things we have to monitor because some of the companies where people are expecting growth should be high, you might actually see that the growth does not match up to expectations. Yeah, I think probability is very high that on an overall basis, we get earnings downgrades this time. Across many sectors except maybe infrastructure, capital goods or automobiles, etc., where as it is expectations are low, so if those companies do better, then that might not happen. But I think consumer goods, technology, and most other spaces like even financials is something which will be interesting to see because their expectations are not as high as they used to be. So that if some companies out there surprise positively, then those stocks will do better.
Overall, the December quarter earnings may turn out to be a muted show as India Inc. battles with faltering consumption, uneven economic recovery, rising input costs, and subdued credit growth. Given this, management commentaries on growth outlook rather than reported figures this quarter will be keenly tracked by market participants. As regards today, investors should expect a range-bound movement amid lack of domestic and global triggers.
Equity market finally acknowledged that Omicron may unsettle economic activities as the stock indices plunged over 600 points yesterday. Effects of pandemic will also reflect on the upcoming union budget, which the centre will table on 1st of February. In the next episode, we explain the Consolidated Fund of India, a key component of the union budget.
In the recently concluded winter session of the Parliament, the government brought the Appropriation No. 5 Bill to give itself the power to withdraw funds from the Consolidated Fund of India. It was cleared in the Lok Sabha amid opposition. The Constitution bars the government from withdrawing money from the Consolidated Fund of India. But the government cited crisis caused by the pandemic as the reason behind taking the step. This fund is defined under Article 266 of the Constitution. It says that all revenues received by the Government of India, all loans raised by that government by issue of treasury bills, loans or ways and means advances, and all monies received by that government in repayment of loans shall form one consolidated fund to be entitled the Consolidated Fund of India. To put in simple terms, all revenues received, interest earned and money borrowed by the government goes into it. It is an account of the revenue the government gets via income tax, customs, central excise and non-tax revenue and the expenses it makes excluding exceptional items. So in every budget, the government lays down a statement of estimated receipts and expenditure before the Parliament pertaining to the next financial year. This statement, titled the Annual Financial Statement, is the main budget document. The Annual Financial Statement shows the receipts and payments of the government under three parts in which the government accounts are kept. Consolidated Fund of India is one of them. The other two categories are Contingency Fund and the Public Account. Consolidated Fund of India includes revenue earned from direct taxes like income tax, corporate tax, and indirect taxes such as GST, customs, and excise duties. Dividends and profits from public sector undertakings, disinvestment receipts, debt repayments, and loan recoveries also go to the fund. All expenditure of the government is incurred from the Consolidated Fund, with the exception of a few transactions which are carried out through the Contingency Fund and the Public Account. No amount can be withdrawn from this fund without authorization from Parliament. The fund has the following two divisions: Revenue Account and Capital Account. The Revenue Account deals with the proceeds of taxation and other receipts classified as revenue as well as the expenditure met therefrom. The Capital Account deals with expenditure incurred with the purpose of either increasing the concrete assets of durable nature or of reducing recurring liabilities. It also includes various types of capital receipts. The Receipts section deals with receipts of a capital nature which cannot be applied as a set-off to capital expenditure. The Expenditure section deals with expenditure incurred with the object of increasing concrete assets of a material or of reducing recurring liabilities. It also includes receipts of capital nature intended to be applied as set-off to capital expenditure. The sections Public Debt and Loans and Advances comprise loans raised and their repayments such as internal debt, external debt, and their recoveries. Certain items of expenditure like salaries and allowances of top government officials are also charged on the Consolidated Fund. They include the President, the Chairman and the Deputy Chairman of Rajya Sabha, and the Speaker and the Deputy Speaker of Lok Sabha, salaries, allowances and pensions of judges of the Supreme Court, Comptroller and Auditor General of India, and the Central Vigilance Commission.
Derived from the Westminster system, the Consolidated Fund is the main bank account of the government where it records all the revenues earned and expenses made. That's all for today. We will be back with more news and analysis on our next episode. Stay tuned and thank you for watching. If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.